Welcome to the Banyan Edge Podcast. Here's your host, Charles Sizemore.
Welcome. I'm your host, Charles Sizemore, and today we are getting in your head. We're going to talk about investor psychology, behavioral finance, if you will. And to help me do that, I have brought on my collaborator, Mr. Adam Odell, who we did have an office pool going for a while that Adam might actually be a robot because Adam seems to be immune to these psychological problems that seem to affect the rest of us in our trading. Mr. Adam here is, he's definitely mastered the art of being cool and analytical. And I say that as the highest compliment I can give a trader, Adam.
I appreciate that. I'll talk about how nobody's ever able to extinguish their biases, but we learn to overcome them if we're aware.
You'll learn to overcome them. Well, so let's start with, I don't know if you saw this, but last week, our colleague Mike Carr actually wrote a fantastic article about investor biases. I love this. It was a nice introductory piece to just kind of wake you up to the biases that are affecting your trading. He specifically talked about a couple. He mentioned the Salience Bias, and I think the vocabulary has changed since my days in grad school when I studied under Adam Smith in the 1800s or whatever. This is what I would have called the representativeness bias, or perhaps even the availability bias. But what it boils down to is focusing on the wrong thing. The Salience Bias is our tendency to focus on whatever's big in the news that day, focus on whatever is getting our attention, but may not necessarily have a real impact on stock prices. It's focusing on the wrong thing. It's something that every investor does. It's something we've all struggled with. How do you get around that yourself? Like, what's your approach?
Well, I don't have a TV in my office. That's kind of rare for a financial person. But I don't ever watch CNBC. I try to read news selectively. The idea is that, as an investor, you want to feel like you have control over your investments, control over the market, and you feel that the more information you consume and take in, the better off you will be. And that's a bias of just thinking that you can do that when all the research shows that you can't. So that's one of the biggest mistakes I see novice new investors make is that watching the news, watching CNBC, and trying to get either tips or get information that they feel is going to be influential in making good decisions. But most of the time, that's just noise. The financial markets are basically an arena where the signal to noise ratio is very low. There's not much signal. There's a whole lot of noise. And if you think that you're going to get an edge by reading articles on CNBC or Yahoo Finance, that's really you're the patsy at the table, so to speak. So I've learned that over decades and just basically try to tune it out.
Yeah, that's a good point. And this goes back to the idea of market efficiency. And one of the entire rationale behind behavioral finance was to, I won't say the whole rationale was to disprove the efficient market hypothesis. That's not strictly speaking accurate, but for decades, the prevailing wisdom on Wall Street and in academic circles was that the market's efficient. Information is already priced in. So doing extra research doesn't necessarily help. It's already priced in. Behavioral finance showed that that's not necessarily true. The market may be efficient in the sense that it processes information, but often it processes the wrong information, and it does so with emotional biases. If you understand that, you can get an edge, yada, yada. But that first part about market efficiency, if you're reading an article on CNBC, if you're watching breaking news on CNBC, the market is efficient in that sense. Whatever you're reading there has already been factored in. Like you're not getting anything new there.
Right.
And that is, there's also sort of an arrogance factor that if you think I'm a smart guy, I can just learn more than everybody else. I can just study a little bit harder. I can just get a little bit more information.
I've actually written on that effect in a fun way. I was a pre-med student. I went to medical school for 1 year, and there's this kind of saying in trading that doctors and engineers make for the worst investors, and that's no offense to anyone personally, but doctors have basically learned that if you spend the time, if you put in the hours, if you read all the books, if you gain mastery of the content, that you can succeed at a high level, and that works for medicine. It also works for engineering. where there are physical laws that govern, gravity and force and mass. But
that's the kind of doctor I want. I want the doctor who actually
absolutely
does the time.
and you do want that in as far as going to a medical provider. But then often those types of people think, all right, well, I've mastered this. Let me go master the markets. And the markets are a whole different beast. You keep referring to the market. And this is something that people refer to all the time. The market does this. The market is efficient. The market is nothing other than a large collection of people making decisions. And so that's really why, the efficient market hypothesis was predicated on this idea of the rational man, that every man and woman who interacts with the market, that makes the decision to buy, makes the decision to sell, or makes a decision to stay out of the market, is being 100% rational. And that's good in theory, but in practice, it doesn't happen. We all have cognitive biases. We all have incomplete ability to process data and information and to understand, relationships and inferences. So our lack of ability to be 100% accurate means that we don't always make rational decisions. Now, that doesn't mean we're purely irrational, that we just go in and play around. A lot of people are making thoughtful decisions.
If we were purely irrational all the time, you could just always bet against us.
Exactly.
It doesn't work like that either.
Yes. And if we were also, that's a great point. And if we were also irrational in different ways, if my irrationalities were different than your irrationalities, then they would probably cancel out. And the net effect on prices and financial markets would be nil. But the fact is, we actually are irrational in predictable ways. You and I make similar types of mistakes and have cognitive biases that are similar, and they tend to force us to do the same types of things in moments of stress of markets. So,
yeah, absolutely. So Mike's his second bias he identifies was herding behavior. And you see this not just in the financial markets, you see it in fashion trends, you see it in music, you see it everywhere. Mm-hmm. Something, a trend maker somewhere, starts something and then everyone follows them. Herding behavior is very natural in humans. I think it probably goes back to our caveman ancestors that figured out that there is strength in numbers. It's a lot easier for 10 or 15 of us to go hunt a woolly mammoth than for one guy to go at it alone, right? Mm-hmm. And so that's hardwired into us to kind of seek validation from each other, to seek kind of help and validation from each other. It could be a disaster if done wrong in the stock market, though.
Yeah, and you hit the nail on the head. I mean, you took my words. There's an evolutionary basis for that. And it's not only that it's easier for 15 cavemen to hunt a woolly mammoth, it's actually almost the inverse of that. If you are the one being hunted, you want to be in a group of 15 because you might be able to kind of get in the middle of that pack and somebody on the outside of the pack gets picked off. And if you decide to leave the pack and say, you know what, I can do this on my own, you're definitely going to get picked off. So that is the evolutionary basis for that. And yeah, you see that in fashion trends. You see that in finance. You see, FOMO, the acronym of the decade, so to speak, fear of missing out. That's precisely hurting. There's this saying that people don't fear risking a certain amount of loss or drawdown in their portfolio. They fear trailing their peers. So if their neighbor, their brother-in-law, just got a new car because he got in on a GameStop trade or something like that. That's more of an emotional risk and emotional pain than simply having a 10% drawdown in a portfolio that you otherwise believe in. So you even see that and that's the other thing is I don't want to pick on retail or novice investors. You absolutely see the same biases in financial professionals, folks that run.
It may be worse in financial professionals.
It may be even worse because there's this thing called career risk, right? And so, everybody, if your fund is meant to track a certain benchmark, there's what's called tracking error. And if you make too many active bets, so, if you deviate from the holdings in that benchmark too much, if either by sheer bad luck in the short term or by poor decisions, you trail that index by a meaningful amount, then all of your fund investors are going to fire you. You may lose your job if it's with a big fund company. So, anybody in the financial world like that falls victim to the same exact biases, including herding.
It's funny. I have some friends that are short sellers, like they're dedicated short sellers. That's what they do. I'm also convinced, I don't mean this in any insulting way. I think there's something a little bit wrong with them. They're not quite normal. Because when you're a short seller, you're always going against the herd. you're always in a position where when you win, all of your friends are losing.
Mm-hmm.
When you lose, all your friends are winning. It really kind of, you almost have to be kind of a mild sociopath to have that level of sort of, independence of thought. So
you do, you're
anyway,
cut from a different cloth. And that's a good point as far as contrarianism and this herding bias. Basically, the simplest way to think about it is that the herding biases causes prices to move past their fair value with a lot more volatility than you would expect by other models. So that can mean either a stock or a market can rally far past its, above its fair value, or in a period of panic and despondency, sellers can force prices down well below their fair value. And when we talk about biases, a lot of people think it's a negative thing that we have these things and we have to think about them, but it's actually the opportunity in the market. There would be no way to beat the market if there weren't for these cognitive biases and these mental glitches, so to speak. But back to the herding, I mean,
these biases create anomalies, and we'll get to that here in a minute. But that's anomalies are the world that Adam O'Dell lives in.
Right. I mean, that's my bread and butter is basically learning the types of predictable behaviors that investors will make in stocks that are not irrational, but suboptimal, and then trading against those. And that's really, I mean, you can either be a contrarian, you can find a stock that's been bid up to the sky and for no good reason, and you can be a contrarian short seller in that situation, or you can be a contrarian value investor if you find a stock that everybody's dumped over the past 3 years and nobody wants to hold, but you see the business is worth a lot more. You don't have to be a contrarian to make money off of these biases. You can be a momentum investor as well. So, stocks that get bid up past fair value.
Well, momentum would be understanding herding, understanding what's going on there, and knowingly jumping into the herd to ride it higher. You have to have rules. You have to know when to get out, of course. You don't want to be the last man standing, but you do, or last man standing, the last guy holding the bag. I think I'm mixing my metaphors here, but
yeah, something about musical chairs. I know where you're going with this. You don't want to be standing with the last chair is taken. Yeah.
There you go. So momentum investing is an idea of you see herding, you witness it, you understand it, and you participate in it anyway because you're playing that game.
Yeah, that was Soros's game. He said, if he sees a bubble, he jumps in, and you just have to know when to get out, and really you have to use a system. I mean, that's the thing is like it's one thing to make discretionary decisions about your investments and think that you can know when to get out, but really most of the time you won't. It'll catch you off guard, the turn and the trend, and that's really why for as long as I've been investing, minus a year probably in the very beginning, I've been a systematic investor, and that's why you might want to call me a robot. But fact is, I don't trust myself. Some mornings I wake up in a good mood. Some mornings I wake up grumpy. I don't trust myself and my mood from day to day to make good decisions every single day. So I build systems that are based on factors and anomalies that have been proven across markets, across time, and then I implement those models with discipline, and I sleep better at night and have better results.
You have rules, and those rules are based on experience. They're based on probabilities, and that's you rinse and repeat, and over time you get it right. That's the secret there.
Yeah, absolutely. And that's really, I mean, I built a whole model that we use in my flagship newsletter, Green Zone Fortunes. It's called the Green Zone Power Rating System. I'm sure anybody watching this has heard about it at least, but it's based on 6 factors, 3 of which are based on the price action of the stock. So is the stock behaving nicely or not? And then 3 of the factors are based on the company's operating fundamentals. So the price-based ones are momentum, size, the market cap of the company basically, and volatility, the volatility of the stock. And the 3 fundamental ones are value, quality, and growth. So it kind of takes a composite look at not only the stock that you are buying when you buy a stock, but also the underlying company behind it. And it looks at 6 factors that have been proven both in the academic research as well as practitioner results. There are a number of funds that run this type of strategy in different forms. And when you combine it, we're really looking for well-rounded stocks that are, cheaply priced but growing, that have good momentum, but that are smaller companies, because smaller companies over time tend to outperform large companies. So that's really what we do there.
Yeah, I'm glad you mentioned that. I was going to ask you about that here. You mentioned, academic studies. I remember back in grad school and even back in CFA study, one of the very first papers that every finance student has to study is the 1992 paper by Fama and French, their three-factor model. Now, some background on that. Fama and French were two of the biggest proponents of the efficient market hypothesis. They were part of that establishment. They believed in the rational man and the rational market. And then experience slapped them in the face, and they realized, well, hold on now, the real world doesn't seem to be following our model here. What's going on? And so then they started to look for anomalies. They started looking for explanations as to why their model wasn't quite working as it should in the real world. And their first attempt at that identified value and size as two factors apart from just the market itself that impact portfolio returns. What they found is, yes, you can be systematic. You can systematically look for stocks that are undervalued. They use the price to book ratio. I know your own research uses a value composite that uses various slices of price to earnings, price to book, price to sales, You have like a whole portfolio of value statistics that you incorporate into a composite. Yours is much more sophisticated than theirs, but theirs was that first slice of let's try this, right? Let's see if it works, and it did. It added value. They also used their size factor, and this one they had a harder time explaining, but they hypothesized that perhaps because smaller companies can't be bought by the big boys on Wall Street, they're just under-researched, and therefore there is value in looking for smaller cap companies. There was also the idea that there may be stale price. They had a whole list of theories as to why it worked, but the fact is it does. Going for smaller companies does over time tend to outperform as well. And so that paper, that was sort of the foundation of kind of quant investing as we know it today. Would you argue that your own six-factor model is sort of an evolution of that?
Well, absolutely. I mean, I stand on the shoulders of giants, so to speak, because, every single one of the factors, and I can't say every single one. There's been this issue in recent years where when computing power has increased and the availability of data has increased, and there's been a pressure for academic researchers to publish papers discovering a new anomaly or factor, lo and behold, dozens, if not hundreds of factors have been discovered. And Cliff Asness wrote a paper, I think it was him that wrote it, called The Factor Zoo, basically just saying that, if you could run, regressions and backtests on infinite amount of data over and over, you are statistically likely to come up with factors that look like that have, high, t-scores, t-test scores. But
that kind of comes back to the old joke that if you have an infinite number of monkeys, banging away on an infinite number of typewriters, eventually they're going to work out all of the works of William Shakespeare.
Absolutely.
You can definitely find statistical noise.
Right. And that's what our, we try to, warn our investors against, is that, not every new factor is worthy of being included in your portfolio, because it may be just kind of spurious. It may not actually be real in the data. There's back testing. What could you make the back test look like it works in the back in history? But then there's forward testing and real world analysis, real world results. And that's what investors actually care about. So I've limited my model to the factors that have been this stood the test of time. So you nailed two of them, size and value. Those were the first two that Fama and French discovered above market beta. And that was really the first time anyone was able to say, because before that, they figured the market beta described all of the stock returns. They basically said there's no way to predict idiosyncratically which stock will underperform or outperform the market. And since there's no way to predict that, your returns are based on how much market beta you're taking. Like, are you just with the market? Are you with the market with leverage? And so that's really all they cared about. But then they realized, oh, wow, buying companies that are cheaply valued can actually outperform the market. Buying smaller companies can actually outperform the market. So those were the first two. And then it was Jagadish and Titman in the 90s that came out with a seminal momentum paper that realized that, like, look, this sounds silly, but if you just sort stocks based on their past 12-month returns and you hold the ones that have been outperforming, that outperformance tends to continue at least for a few more months, anywhere from 1 to 12 more months. So you can actually earn a premium by doing that. And that's because of the herding behavior. One point here is that some of these factors work for behavioral reasons, because humans are making these not fully rational decisions. because they're biases. And some of these factors work because they are risk-based, meaning that you are taking on a bit more risk to invest in smaller cap companies. Often a small cap company may not have the depth of management. They may only have one or two product lines, where a larger company may have 12 product lines. They may not be able to access capital markets as efficiently, so they may pay more for debt or not be able to raise as much equity. So there are some reasons why, in theory, you should earn an above market premium in a smaller company, because all things being equal, you tend to take a bit more risk in those type of companies. But if you can diversify that risk away by investing in a number of different companies, a number of different factors over different time frames, then you can earn that premium, and through diversification, bring your overall portfolio level of risk down to an acceptable level.
Yeah, it's funny. It's one of the things I really like about your model is because the factors are weighted equally, you can build a highly rated portfolio diversified across several stocks that are rated highly for different reasons. And ideally, a stock can be rated highly on all 6 factors, but there's generally going to be some factors that are rated a little bit higher than others for a given stock. So you can diversify by having several highly rated momentum stocks, several highly rated value stocks, highly rated growth stocks, et cetera. You can really build it out like that. That's a very nice, versatile aspect.
And not only that, occasionally you do find one stock that embodies several of the factors that you think would be counter to each other. So a lot of people think I'm either a momentum investor, I buy things that have been soaring recently and that everybody's talking about on the news, or I buy value stocks that nobody knows about, that nobody cares about. When in fact, some of the best stocks are stocks that are trading at a cheap price, they're value stocks, but something has happened in their business. There's some inflection point where the early investors have caught on to that, started buying the stock at a discount. Maybe the discount is closed from minus 40% to minus 35%. But if you can buy in while that stock has gained some momentum, regained an uptrend, and still cheaply valued, then you can get into both a momentum and a value stock. And look, that doesn't mean that the company's profits aren't growing as well. So you can really try to find some stocks that are well-rounded, or to your point, you can find a really, really cheap value stock and pair that with a really, really growthy stock that maybe is fairly priced, but has double or triple digit earnings per share growth. So
very true. Very true. Let's go backwards for a second and touch on Mike's third point. And this is a really good one to me, because this is one where your ego can really get you. And it's anchoring and adjustment. This is the bias we have to where we make a point, whether it's I like whatever, make up a stock. I like Microsoft stock, or I think the market's going to go up by this percentage, or whatever. Just pick your hypothesis, you make it, and then rather than just say, okay, like I was wrong, things didn't go that way, I'm just going to start over with a new hypothesis. I'm just going to scrap that one, take all available information right now, and come up with a new hypothesis. Instead, you stay anchored to something that's clearly not working. You try to maybe tweak it around the edges, just sort of tweak you're still anchored to it, but you just make very slight changes to it, when what you really should do is just be done with it and move on. Now, this to me, well, it's a couple things. One, your ego will kill you in this business. If you cannot contain your ego, if you can't get rid of your ego, then you're dead. Like you will lose money and you will not make it as an investor. So that kind of comes back to your rules-based investing, where the best way to conquer your ego, the best way to keep your ego in check, to keep that thing in a box locked away, is to simply have rules that you aren't allowed to second guess. And that comes down to what you do. A lot of your investing is very algorithmic, very rules-based. You get into a trade based on the criteria. If things change, you're out. If it doesn't go right, you're out. You come up with a new hypothesis, you start over. That's hard. Like not very many investors ever master that. The ones that do tend to stick around longer. The ones that do tend to be a lot more successful.
Yeah, I mean, if you think about what data-driven investment strategies are trying to do, whether you call them AI or machine learning or just more traditional data-driven strategies, They're trying to take what's called a Bayesian approach, where every new data point of data that comes in is being incorporated to the model and being incorporated to the opinion that the model had 1 second before that data point came in, and you're constantly updating that. And that's really probably the image that the rational man theorist had in mind when they thought about people buying and selling stocks. But if you talk to anybody over the age of 80 or 90 and have them tell you stories, they kind of show the anchoring bias, because they will often talk about a decade in their past that they are very fond of or that was most impactful for them. And they are kind of stuck on that decade, and they believe that the world should still operate that way or does still operate that way. And what they haven't done is they haven't updated their references, or they haven't updated their view of the world based on what's been happening in more recent time. And that's exactly what happens in the market. The example Mike Carr used was GameStop. And it's hard to pick a target for a stock when it's trading at its highs, but once it's set a high of, let's say, $120 and then falling back 50%, well, suddenly you see that high as the anchor, and you think, well, there's no reason why the stock can't go back to 120. If I can buy it at 60, then I've got a 60% discount. When the fact of the matter is the business might be worth $10 a share. And it may never get back to $120. The other way that the anchoring biases messes people up is this idea of it's kind of related to the disposition effect, where you don't want to sell a losing position. And it goes back to the ego idea. So let's say you buy a stock and you feel really good about it, you're confident in it, you think that you've made a really good find, and suddenly that stock is down 10%. And you don't want to take the emotional or the ego hit of selling that stock and thinking, oh, I made a bad decision, even if it's only a 10% loss. But so what you do is
it's an admission that you were wrong.
Exactly. So it's more of a psychological loss than an economic one. And so what most people do is they'll say, okay, well, maybe this wasn't as good as I thought, but what I'll do is I'll wait till it gets back up to my break-even price, my entry price, and then I'll sell. It'll be a wash. We can all pretend it didn't happen. And then lo and behold, that 10% loss turns into a 15, 20% loss, and then a 30% loss. And then usually people end up selling toward the bottom. And that's really why, that these prices can get out of line with fair value, is that, people don't want to follow a rules-based system. We use trade stops in my portfolio. So that's a volatility adjusted stop program, where based on the volatility of the stock, you choose where you're going to get out of the stock if it goes against you. And you try to maintain this discipline to that, because there's so many factors that can make a stock or a business deteriorate on you, that you have to have some measure of risk management, or else, it risks taking the whole portfolio down with it.
You have to have those rules, and you have to have them on before the trade starts. Otherwise, it becomes a very messy mental game, and one that very few people ever win.
Absolutely.
But I'm glad you mentioned trade stops, because our friends over at Trade Stops have actually developed something I like. Now, you mentioned their volatility-based stop losses. That's something I've personally used for years. I think that's fantastic. They've actually put together an AI model that looks to predict market moves as much as 30 days in the future. And of course, this is not, voodoo. This is not, something like, they're not just divining market moves, because that doesn't work. But what they are looking at is they are crunching the data. They're looking at what factors are working now, because different stock factors are different stock factors tend to be in vogue at any given time. Mm-hmm. And so if their models tell you, look, right now we see this, the data supporting this, value is in, or whatever, small caps are in, pick your poison, or some combination of value, momentum, like this is the combination that's working right now. And that's how AI can be used in a model like this. They call their model Annie, like the woman's name, although they spell it AN-E. You got to make it sound like a robot, right? It's got to sound futuristic, but
give it a name.
It's a good name, right? But anyway, if you like what we've discussed today, you like this idea of quantitative investing, factor investing, rules-based investing, using data, letting the data guide your decision, taking your emotions out of the equation, then this is something you should check out for sure. We'll put a link below. Strongly recommend you give it a look. Well, Adam, we are out of time. Thanks for joining us. And I will joke once more about the robot thing. You may need to go plug in or restart or whatever it is a good quantitative trader does.
Absolutely. I'll reboot and come back ready to go. So it was good talking with you, Charles. Hope you're doing well, and we'll talk again soon.
Thank you. Have a good one.